I think what people need to realize is that the U.S. economy never achieved the escape velocity that we would have liked, and policy rates never got as high as we would have liked to have seen. And then suddenly you're faced in an environment last summer where the Fed needed to come in, but they're coming in from 2.25%, 2.5%. And you're very quickly at the point where you think if this leads to recession, they've got to bring rates down to zero, and the rest of the world will come into the U.S. bond market and bring the 10-year down to zero. Now, of course, I didn't foresee coronavirus, but
you didn't have to. Yeah,
it does look like we're headed to recession. At least the probability has gone at least to 50-50, and the market's pricing that in.
If we don't see, before I bring Steve in, Bob, if we don't have recession, then what? You know, does this whole thing unwind if that event doesn't come to pass?
It doesn't unwind. And I think what we're seeing today is, I know that yields are very low. I know there's been a shock to the markets. But right now, the bond market is relatively stable. Government bond yields are stable at lower levels, and credit spreads are stable at much wider levels. Frankly, we're all waiting for a policy response. We want to see if the Fed or the ECB come in, whether they say something, indicate some sort of policy, and we want to hear out of Washington and Brussels.
Okay.
So we're looking for that type of support.
All right, I'll bring in Steve with my graphic of the day. Steve, comes from your team. This is the market betting a 16% chance of negative rates come July. Now, I realize we make these graphics up to show them on TV without me holding them up.
Television. I didn't know you needed it.
But I printed it out here because it's so shocking to me. So tell us what we're seeing.
Let me update that number while you're talking because it moves around a lot.
When you have the 10-year hitting under 35 basis points.
Is that July? It's 18% now for July and 15% for June.
Wow.
So I have never actually seen the thing that I look at from Refinitiv with a probability of a negative rate, but that is certainly something out there. I think it's something the Fed doesn't want to do. But let me just tell you what my reporting tells me today, which is the Fed stepped in this morning to provide additional liquidity to the overnight market. And what I'm hearing is that the many people are familiar with what's going on, and I'm thinking Bob has some thoughts on this as well. I think the Fed has to do much more here on the liquidity front, that the bond market is not necessarily trading all that well, that there are half-point gaps between the bid-ask spread. Guys, if you could bring up the Evercore full screen, I just want to show you what Krishna Guha said shortly after the Fed came out with its increase in the repo overnight, and what Krishna said, who's a former New York Fed official. He said, it's a baby step with only short-term changes, limited term funding, and no global reach. In our view, much more will need to be forthcoming and very soon. What I've been hearing people talk about is the rekindling of swap lines between Japan and the United States, dollar swap lines, that is, United States and Europe, provision of special discount window provisions. The idea is that there are problems in the interbank funding market that are not all that obvious.